Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're taking a closer look at the Greater Toronto Area housing market, which saw a boost in September following a recent interest rate cut.
That's right, Sandy. The Toronto Regional Real Estate Board reported that home sales rose by 8.5% compared to last year. Nearly 56,000 homes were sold in September. This increase is largely due to homebuyers wanting to take advantage of more affordable monthly mortgage payments.
Exactly, Steve. It's interesting to note that while sales have improved, they still remain below what we'd consider normal levels relative to the number of households in the Greater Toronto Area. Jason Mercer, the Chief Information Officer at TRREB, mentioned that further interest rate cuts by the Bank of Canada could align monthly mortgage payments more closely with the average incomes of home buyers, potentially boosting sales even more.
That's an important point, Sandy. The average selling price in September was down 4.7% from last year, sitting at around $1,059,000. It's a significant drop, but one that could make purchasing a home more accessible to many.
And while we're seeing a rise in sales month over month compared to August 2025, it's worth mentioning that new listings have actually decreased. This could potentially create a more competitive market as buyers are eager to capitalize on the current conditions.
In Durham region, apartments experienced the most significant price drop, nearly 6%. This might be a great opportunity for first-time buyers or investors looking to enter the market at a lower price point.
Absolutely, Steve. It's a dynamic time for the housing market in the Greater Toronto Area, and it will be interesting to see how these trends evolve, especially with the potential for additional interest rate cuts by the Bank of Canada. Home sales in the Toronto region are seeing an upward trend as we move into the busy fall market. According to the Toronto Regional Real Estate Board, sales in September rose by 8.5% compared to the same month last year. Steve, what do you think is driving this increase?
Well, Sandy, it seems that improved affordability is a key factor here. The average home price in September was down 4.7% from the previous year, sitting at just over $1,059,000. Lower prices and borrowing costs are making it easier for some buyers to enter the market.
That's true, Steve. It's interesting to note that while prices have dropped significantly, down over 20% since the peak in February 2022, sales are starting to pick up. Jason Mercer from the Toronto Regional Real Estate Board mentioned that these conditions are encouraging buyers to move off the sidelines.
Exactly, Sandy. But it's important to remember that we're not back to the levels we saw during the peak. New listings were up 4% year over year, which could indicate a tightening market. However, active listings have increased by almost 20%, suggesting that there's still plenty of inventory available.
That's right, Steve. The market dynamics are quite intriguing. Although prices are relatively flat from August, with just a 0.2% increase, the fall season is typically a busy time for real estate. It'll be interesting to see if this trend continues as we move forward.
Yes, and it's worth noting that detached home prices in Toronto dropped by 0.8% compared to last September, which is a much smaller decline than the 10% drop we saw in August. This could be a sign of stabilization in the market.
Absolutely. And townhomes in the 416 area saw the most significant sales increase, up almost 40% from last year. It seems townhomes and semi-detached homes are becoming more attractive entry points for buyers in the city.
That's a good point, Sandy. The market is still challenging for many, but potential further interest rate cuts by the Bank of Canada could help make homeownership more attainable by reducing monthly payments.
We'll have to keep an eye on the Bank of Canada's decisions in the coming months. Any further rate cuts could have a significant impact on the market, It's a complex picture, but one that's definitely worth watching. In September, the Greater Toronto Area saw a notable increase in home sales, with 5,592 transactions recorded through the Toronto Regional Real Estate Board's MLS system. This marks an 8.5% rise compared to the same period last year. Steve, it's clear that the market is experiencing some shifts.
That's right, Sandy. Alongside the rise in sales, there was a 4% year over year increase in new listings, bringing the total to 19,260. However, when we look at the seasonally adjusted figures, we see that while home sales were up month over month, new listings were actually down. This suggests a potential tightening in some housing segments.
The MLS Home Price Index composite benchmark showed a decline of 5.5%, and the average selling price was approximately $1,050,000, which is down 4.7% from the previous year. Steve, do you think this drop in prices is making the market more accessible to buyers?
It certainly could be, Sandy. Lower prices can make homeownership more attainable, especially when paired with the recent interest rate cuts. The TREB's Chief Information Officer, Jason Mercer, mentioned that further interest rate reductions by the Bank of Canada could align monthly mortgage payments more closely with homebuyers' average incomes, potentially boosting sales and economic activity.
That's a good point, Steve. While sales have improved, Jason Mercer also pointed out that they still remain below what we'd consider normal levels when compared to the number of households in the Greater Toronto Area. It's a reminder that while things are moving in a positive direction, there's still room for growth.
Exactly, Sandy. The market's showing signs of stabilization, but it's important to keep an eye on the broader economic factors at play. Interest rates, in particular, will be a key component in determining the future trajectory of the housing market. If the Bank of Canada does decide on additional cuts, it could lead to increased activity in the market.
And as we move forward, it'll be interesting to see how these dynamics continue to evolve. The fall season is traditionally a busy time for real estate, and with the current conditions, it could be a pivotal period for both buyers and sellers. The Bank of Canada has recently cut its interest rate to 2.5% after a period of pausing to assess the impact of U.S. trade policies on inflation and economic activity. Steve, this decision comes on the heels of weakening employment figures and diminishing inflation concerns.
That's right, Sandy. The bank's move to resume rate cuts reflects a strategic response to current economic indicators. With the policy rate now at 2.5%, this serves as a benchmark for short-term interest rates, influencing longer-term rates like those for mortgages and business loans. It's a crucial lever for monetary policy.
Exactly, Steve. And it's interesting to note that the Bank of Canada has been quite active in adjusting its rates. After a series of hikes that took the policy rate to 5%, they've now shifted towards easing monetary policy. This has been a calculated move to strike a balance between supporting economic growth and managing inflation.
Indeed, Sandy. The bank raised rates 10 times over 18 months, reaching a peak of 5%. This aggressive tightening was necessary when inflation surged, but with the current economic climate, easing seems appropriate. The recent cuts bring the rate to what's considered a neutral level, neither stimulating nor constraining economic activity.
And Steve, it's important to consider how these rate changes impact average Canadians. With mortgage rates having risen during the rate hikes, many homeowners felt the pinch. However, the recent cuts are providing some relief, making borrowing cheaper and potentially stimulating the housing market.
That's a critical point, Sandy. The interest rate cuts are not just about mortgages, they affect consumer debt across the board, including credit cards and personal loans. The broader economic impact is evident as well, with the cuts providing a boost to the economy after a period of slowing growth and rising unemployment.
We should also keep an eye on the upcoming Bank of Canada interest rate announcement on October 29th. It'll be accompanied by the quarterly monetary policy report, which often outlines forecasts for the economy and inflation. This will be a key moment to watch for any further guidance on rate adjustments.
Absolutely, Sandy. Financial markets are already speculating on another potential rate cut, with current odds at around 40% for a quarter point reduction. However, much will depend on external factors, particularly US, trade policies, and their impact on the Canadian economy.
And while the Bank of Canada is navigating these complex dynamics, it's clear that their approach is one of caution and careful consideration. Governor Tiff Macklem emphasized that the bank would proceed carefully, looking over a shorter horizon than usual to better balance the risks.
Right, Sandy. The central bank is in a challenging position, having to balance between supporting the economy and preventing inflation from spiraling. It's a delicate act, but with the current economic indicators, it seems like the bank's decisions are aligned with the needs of the economy.
Let's dive into the shifting landscape of Canada's mortgage market. Demographics are changing rapidly, and this has huge implications for both the mortgage and housing markets in the coming years. According to Statistics Canada, Canadians aged 65 and older represented just under 19% of the population in 2023. This figure is expected to rise to between 21.4% and 23.4% by 2030. Steve, these numbers suggest significant changes ahead.
Absolutely, Sandy. This demographic shift means that many older Canadians are feeling financial strain as they approach retirement. This could be due to rising living costs or the need to support their children or grandchildren. On the other hand, younger Canadians are also facing the challenge of supporting their aging parents, which is leading to a rise in multi-generational homes.
That's right, Steve. Imran Thaver from CWB Optimum Mortgage highlighted at a recent summit that younger Canadians who might have traditionally moved out at 18 are now staying home longer. Meanwhile, others are considering how to accommodate their parents. Multi-generational homes are becoming more popular, and lenders are keeping a close eye on this trend.
From a lending perspective, this means that policies need to evolve to address these changes. Lenders are focusing on flexibility and adjusting their lending criteria. Nelly Uzbasian from Equitable Bank pointed out a significant gap between Canadians' retirement savings goals and what they have actually saved. This gap is likely to lead to an increase in reverse mortgages as more Canadians tap into their home equity.
It's an important trend, Steve. Leah Zlatkin, a moderator from Mortgage Outlet, advised brokers to engage with their clients about the older members of their families who are nearing retirement. She emphasized that understanding these demographics can help brokers expand their business, especially when the market is slower.
Indeed, Sandy. Riaza Ali also encouraged brokers to look at the demographics of their clientele. He noted that even in the current market, there are Canadians ready to purchase homes. Identifying and reaching out to these potential buyers is crucial for brokers looking to grow their business.
Greg Sinclair from Magenta Capital Corporation discussed the importance of strong communication with lenders, especially for borrowers in industries affected by tariffs. He emphasized the need for borrowers to have a clear plan and exit strategy to increase their chances of securing funding.
And Sushanta Sen from MCAP highlighted the responsibility of mortgage brokers to educate themselves and their clients. In this uncertain economic climate, brokers need to act not just as mortgage advisors, but as financial advisors, looking beyond rates to understand their clients' overall financial situations.
Canada's housing market has seen a notable improvement in affordability over the past 2 years, though regional divides persist according to the latest report by the Parliamentary Budget Officer. Steve, the gap between average house prices and what a typical household can afford has shrunk nationally, but some cities remain financially challenging for many households.
That's right, Sandy. The report highlights that the national affordability gap has decreased significantly from 80% in September 2023 to 34% in August 2025. This improvement is largely due to slower house price growth and falling interest rates. However, it's important to remember that this improvement isn't uniform across the country.
Absolutely, Steve. Jason Jacques, the interim parliamentary budget officer, pointed out that while some cities are experiencing better affordability, others are becoming increasingly out of reach for the average household. This disparity is largely influenced by the Bank of Canada's policy rate, which dropped from a peak of 5.0% in mid-2023 to 2.75% by March 2025. This change has eased mortgage costs significantly.
Yes. And with average 5-year fixed mortgage rates falling from 6.5% in late 2023 to 5.1% by August 2025, it's clear that these shifts are helping to restore some balance to the market. However, cities like Toronto and Hamilton, despite seeing the biggest gains in affordability, still have average home prices that are well above what a typical household can afford. It's a mixed bag, really.
Indeed, Steve. While Toronto and Hamilton have made strides, Halifax now holds the widest affordability gap at 74%, whereas Edmonton has the smallest at just 4%. On the other hand, cities like Calgary, Montreal, and Quebec have seen a deterioration in affordability, but their mortgage debt service ratios remain lower than those in the country's most expensive markets.
It's interesting to see how financial vulnerability varies across these key markets. The PBO's analysis shows that even with improvements, households in Toronto, Vancouver, and Victoria remain financially exposed, spending a large share of their income on mortgage payments. This is a critical point for potential buyers to consider.
Exactly, Steve. The Canada Mortgage and Housing Corporation's analysis aligns with the PBO's findings, suggesting that a return to early 2000s affordability levels is unlikely in many regions. Instead, the focus is on restoring conditions seen in 2019. Despite these efforts, many first-time homebuyers are choosing to stay on the sidelines, waiting for more favorable conditions.
That's a good observation, Sandy. According to Anne-Elise Cugliari-Allegretti from Royal LePage, consumer confidence is still somewhat low. Many are hesitant to make significant financial decisions, opting to build up savings for a down payment rather than jumping into the market immediately. It's a cautious approach, but perhaps a wise one given the current economic uncertainties.
The Bank of Canada recently issued a warning to traders, suggesting that they might be placing too much emphasis on its so-called preferred core inflation measures. These measures, CPI trim and CPI median, currently show yearly price pressures around 3%. However, according to Deputy Governor Rhys Mendes, the central bank's broader suite of gauges indicates underlying inflation is closer to 2.5%.
That's an interesting development, Sandy. Mendes highlighted in a speech that labeling these measures as preferred might have led markets to focus more on them than the Bank of Canada actually intends. He emphasized that the bank doesn't want Canadians or markets to be overly focused on a single indicator when assessing inflation.
Indeed, Steve. This is part of a broader narrative from the central bank to de-emphasize these two metrics and focus on a wider assessment of price changes. The recent decision to lower the benchmark policy rate to 2.5% was based on evidence of a tariff dispute with the U.S., impacting the Canadian economy and jobs market, rather than solely on these core measures.
That's right, Sandy. The bank's decision reflected a strategic response to current economic indicators, noting that upward momentum on inflation had dissipated. Mendes also mentioned that the central bank is considering revising its inflation gauges to exclude mortgage interest costs, which can obscure the broader inflation response to policy rate changes.
And it's not just about revising existing measures. The Bank of Canada is also exploring new ways to assess inflation, such as incorporating artificial intelligence and multivariate core trend inflation. This reflects a move towards a more comprehensive understanding of inflation dynamics.
Exactly, Sandy. However, as Dominique Lapointe, an economist at Manulife Asset Management, pointed out, adding more inflation measures could make it harder for the public and market participants to understand the bank's view on inflation. This is a concern that the central bank will need to address as it continues to refine its approach.
Absolutely, Steve. It's a delicate balance between providing a nuanced view of inflation and ensuring transparency for the public. As the Bank of Canada prepares for its framework renewal in 2026, it'll be interesting to see how it addresses these challenges while maintaining its 2% target for the yearly change in the Consumer Price Index.
Yes, and the evolving landscape of inflation assessment is crucial for setting interest rates. The Bank of Canada's approach will influence not only economic policy, but also how Canadians perceive and react to inflationary pressures. It's definitely a topic we'll need to keep an eye on.
Let's shift our focus to the best fixed and variable mortgage rates of the week. This is a topic that many Canadians are keenly interested in, especially given the current economic climate.
Definitely, Sandy. With the Bank of Canada in a bit of a holding pattern, markets are essentially flipping a coin on whether we'll see a rate cut or a hold at the next meeting. There's a 50-50 chance of either a rate hold or a 25 basis point cut, according to the latest data from LSEG.
It's worth noting that Canada's gross domestic product numbers came in slightly higher than expected for July, Steve. The real GDP grew by 0.2%, marking the first growth in 4 months. This has set the stage for an anticipated 0.8% growth in the third quarter of 2025, which is stronger than what many had forecasted.
That's right, Sandy. While the GDP numbers are encouraging, they're still below the Bank of Canada's forecast from July. The central bank's recent move to lower its interest rate by 25 basis points in September was a strategic decision aimed at bolstering the economy. With no clear hints from Governor Tiff Macklem on future rate directions, analysts like Andrew Grantham are speculating that another cut might be necessary to prop up economic activity.
And let's not forget how these rate decisions impact mortgage rates. RateHub.ca provides a comprehensive list of the best fixed and variable mortgage rates available. Steve, this is crucial information for anyone looking to buy a home or refinance.
Absolutely, Sandy. RateHub.ca is a great resource for Canadians shopping around for the best mortgage rates. They offer insights into the lowest available rates for each term and category, whether insured or uninsured. It's a valuable tool for navigating the mortgage landscape.
As we wrap up, it's clear that the decision-making process at the Bank of Canada remains complex, influenced by a mix of economic indicators and market expectations. Canadians should stay informed about these trends as they can have a significant impact on personal finances.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals.
Catch you next time, and stay informed with the latest industry insights.